In this video, guys, let's explore trading the open. Stay tuned. Hey traders, warm welcome to you. So I want to do this quick video to kind of explain some of the concepts of trading the open and the broad ideas, and more importantly, some of the traps that people fall into trading the open. Been there, done it. I am one of the ones who's fallen into this before. I know traders are doing it at the moment. Hopefully this will help you kind of trade the open more effectively. So I'm not going to go into details or nuances about the strategies. You've probably got a few strategies you trade at the open, but ultimately they're in four buckets, right? You've got four ways to trade the open. You trade the dip and rip, which is that kind of fall down and then it just rips off. You trade an opening drive, which is aggressive buying or aggressive selling right off the open. You trade the pop and drop, it's the opposite of dip and rip, that kind of pop off the open, creates that inefficiency and comes straight back again. Or there's chop, which just kind of sits there and does nothing. There's nothing news coming out. There's no real supply demand imbalance. It's just trading pretty much where it was yesterday. And now you may have a filtering criteria to get involved with the open. If you're trading stocks, for example, you might be like, okay, I want to trade stocks that have pre-market volume, or they've got a gap, or they've got earnings. If you're trading, let's say, the indices and you're trading the cash session open, you might not have a filter. You might be like, okay, trade the open depending on what I want to see. Now, the key point here, and something that helped me loads, is to go in with the mindset of my default position is no trade. My default position is no trade. In other words, I'm expecting not to trade unless something very, very exciting comes up and smashes me in the face and says, Mark, you need to trade this. That's the better position to trade in or approach trading in my opinion, rather than I need to find a trade, I need to find a trade, I need to find a trade. Because the open is a very seductive time of day for day traders. You've been off, you've been sleeping, you wake up, you're ready to go, you want to make some money, you're in gear, you are so raring to go, you're the most excited about trading you ever are, and the open. And then prices moving aggressively, swinging around, boom, boom, boom. You see activity, you see volatility, and all you see are dollar signs, and you think, yeah, if I can just grab some of this volatility, I'm going to make a lot of money, and it's going to be great. I'm going to make 10 grand before my first coffee, and really, it has to be more structured than that. There are opportunities at the open, absolutely, because there's lots of inefficiencies. But if you're not careful, you're the one that's getting caught out. You're the one creating those inefficiencies because you're in too early. Then you're having to spit out the position because you don't like it. You're in too late, and then you're having to close the position because it's pulling back. You've got to be much more structured than that. And so, when you look at these four buckets, these kind of dip and rip, opening drive, pop and drop, chop type thing, one of the best ways to approach this is to segment these off into those buckets and say to yourself, okay, what are the three big things that I need to see to categorize the open into this? And so you might say, right, my dip and rip, what do I need to see for the dip and rip? I need to see X amount of bars to the downside. I need to then see an exhaustion bar, and then I need to see a bigger green bar that's larger, should I say, than the previous red bars, or whatever it is, right? I'm just making this stuff up because it's up to you to come up with this. I don't want to force my rules onto you and say, hey, this is exactly how you should trade the open. This is kind of a theory and a process and an approach. And so you then say, right, the dip and rip has to have these attributes. If it is this, now how will I trade that? So once you've categorized that open, and by the way, this is kind of my categories, you create your own. You say, right, actually I need this, I need this. But if it's, most of the time you're not going to get this, most of the time you're going to get chop, unless you're filtering and say using screening criteria and bringing to your attention some of those high quality trades and gappers and stuff. So dip and rip, you say, right, it's going to do this, do this, do that. And how I'm going to trade that is I'm going to wait for the first green. I'm going to then buy on the close of that green. I'm going to put a stop below the low, and I'm going to look for a move back to the open. There you go. You can create a system. You create a system, but what you've done at the open is, rather than you going, oh, what is it? And should I sell this? Is it opening drive? Is it this? You've just gone and looked at it systematically and said, it's ticked these boxes, therefore it's in this category. I trade this category by this. These are my triggers. Now I just have to wait. It simplifies the process massively. And what it does do is it puts the brakes on where you're trading at the open. Because many traders who trade the open are so eager to trade. They get in and they're getting caught out on what are good moves that are setting up nicely just too early in the deal. And so dip and rip, you categorize that. Your opening drive, you might categorize that by saying, hey, an opening drive type open is when I see X amount of candles in one direction that are large and a very, very small candle, flag, consolidation, doji type pattern at the highs. Great. That now is an opening drive, it's X% in X minutes or whatever it is. The way I trade that is I look for the first pullback on here and I trade the wick, or I trade the breakout, whatever that structure is, just some ideas. But the point is, you've categorized that, and then rather than you saying, hey, is this a dip and rip? Is it a pop and drop? You said, no, I've categorized this as an opening drive because we've had 4 consecutive bars. A pop and drop only has 2, and it has this and it has this. So even though you might not be right all the time, it's easy to stand here and say, well, it's black and white, it goes into this box. Now, there's going to be some that aren't quite right, but that's what your stop is for. But what it does do is it helps guide you into the right strategy for the right conditions. It helps guide you into the correct risk management structure for that trade. And it helps you refine this process. With the categorized bucket idea process, you're bucketing each one of these opens into this. And then you start collecting the data as well, and you go, hey, look at all these opening drive trades. What's the commonality of them? Should that be an opening drive trade? Do I need to change the criteria? Do I need to change the way that I trade those? You get the idea. Pop and drop, same time thing as the dip and rip, and then chop, which is going to be the most common thing that catches you out. It looks like it's going to do this, it looks like it's going to do that, but there's certain attributes that say this is a choppy type of market. Maybe it's oscillating around the VWAP. It's early to be using that VWAP, but if it's not having too much excursion away from the VWAP before it's coming back, maybe it's oscillating around. And you've got these dirty candles, I call them, red, green, just completely different shaped candles all the time. Then there's probably chop. You need to categorize into that, and your plan for chop is do not trade it until we break out, and then review and look for the next sequence of events, the next market sequence. And so having this categorization process really just helps your decision making. It helps reduce the cognitive load during the trading day, because it's right when the open bell goes off, there's a lot going on. Right, and you've got to appreciate that. There's a lot going on. You're looking for trades. What market am I trading? Am I trading this? And there's activity, there's volatility, there's excitement, there's this, there's that, the other. You're raring to go. It's such a vulnerable time to be a trader. Yes, there's opportunity there because we're capitalizing on the vulnerability of others and the execution, the algos and the market orders and excitement. But you need to be the one who's stepping back, observing, planning, structuring, categorizing, and then taking the trade. Because that is going to set you apart from everyone else who's getting chopped up in the open and is creating that opportunity. Let everyone else get chopped up. Let everyone else chase stuff. And now and then they're going to have big wins. Now and then. But if they carry on doing that, they're the ones that are creating the opportunity for you. They're the ones that are buying too early and it's ripping. They're the ones that are having to throw that position up, vomit the position out. You spot that as exhaustion. You've already categorized that as a kind of pop and drop type trade. You see that exhaustion after 10 minutes, bang, you've waited patiently for it. Everyone's out, right? Supply demand shifting, I'm in, great, insights, back to the open, done. That's the way to trade the open. Calm, collective, observing, not reacting, but anticipating. Take care, keep your risk managed. I'll see you in the next one. Thanks guys, bye-bye.